Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today, what we're going to go over is I'm going to look at the oil price and gold price and show you they're basically the same pattern that happened in the last consolidation period versus the recent consolidation period. And then the price took off after breaking its downtrend line. Uh, I propose that it's the same pullback. They look a little bit different between oil and gold, but they're the same patterns that repeat over and over. And actually, it's the same of oil and gold, just looking at it right now. They're the same pattern. It's the same pattern over and over, the consolidation patterns. And we'll look at these patterns. What I'm going to do is I'm going to take a big picture view and I'm going to kind of zoom in for gold. And we've got an energy crisis. It's ahead of us. It's spreading all around the world. And then, there might be ramifications that I can't think of. But I would think that the safest spots to be would be something that has no counterparty risk, like gold, silver, platinum, stuff like that. And then anything in the energy sector, because if that's what's causing the problem, you can be directly invested in what the problem causer is. And if investment isn't going into it, I think eventually investment will. You've got everybody, they're all FOMOing at the mouth. They're looking at oil. It's going vertical. And you're just going to get more people to pile in over time. And another thing that, like gold over there, oil is kind of the feeder of inflation. Well, I should say inflation comes in the system. Oil then goes up, and then oil distributes that inflation to everything else through higher input costs. So that's kind of how it works. And I'm trying to think of precious metals and gold and whatnot. What would cause money to flow into gold and other precious metals? And in my opinion, it would be higher interest rates from higher inflation. So if oil in an energy crisis causes a whole bunch of inflation and shortages, I think higher interest rates will follow. We've seen that in the 1970s when we had that energy crisis of peak oil in the United States. And then we had to import a lot more oil, et cetera, et cetera. But that had higher interest rates, it had a bigger demographic, and it had an expansion phase of real estate all aligned. We've got the same alignment today. Real estate expansion phase, same alignment. And we've got all these alignments that are basically just like the 70s. So I would suspect that higher interest rates are going to try to come. And I don't know what the Federal Reserve is going to try to do. They're either going to sacrifice this dollar and that thing's going to get absolutely slaughtered. I mean, slaughtered. Or they're going to raise interest rates, bankrupt everything. And if we have shortages and GDP starts to collapse a little bit, we're stuck with a bunch of debt. This could be interesting. Now, if debt starts to collapse and we see these energy shortages out in the future, I don't know how debt's going to hold up because there's going to be a problem there. You can either get slaughtered through a declining dollar or you get slaughtered through higher interest rates. And then if this thing gets so high that it starts to collapse debt, then what we would see is interest rates spike because everyone's going to sell their debt. So it's when you think about this, it's scary because all the roads, if you have this huge inflation and the debt doesn't go bust, gold will go higher. Now, if you take the worst case scenario where oil goes so high and we have and natural gas and energy becomes scarce, then your debts start to collapse and interest rates go up because everyone's going to sell their debt. I think that's the correct outcome to think about it. And everyone's going to rush into gold too. It's kind of the same scenario. So I think precious metals is a good spot to be in general. Gold, silver, platinum, all of the metals. And some may perform better than others. Maybe gold will perform the best because it's a monetary problem, if that outcome exists. I don't know if it will. Maybe silver is going to be the best bet because silver is an input to renewables. And if they try to solve an energy crisis by tripling, quadrupling, 100 timesing down on renewables, maybe we run into shortages of silver. Now, there are scenarios where you get into a funky kind of situation. Let's say that we have an energy crisis and we can't grow the economy and debt starts piling up, which it has been, and they can't pay the debt off. So people start selling debt in mass and interest rates start moving up. They get scared. That money gets scared and starts piling into precious metals. At the same time that the government is trying to implement solar and wind and all these other renewables with many trillions of dollars. So we have everyone trying to pile in the same stuff all at the same time, which then in turn pushes hydrocarbons higher because you run into material shortages of your inputs of your renewables. I'm just throwing out scenarios, guys. Doesn't mean that I suspect this to happen. I'm saying, what if? And if you can find an investment where the downside or the risk to the downside is limited, but the upside potential could be massive, that's where I really start throwing money around, because the downside's taken out. Everyone hates gold right now. Everyone hates silver right now and platinum. Like, nobody wants precious metals. And you can buy something that's outside of the system. And if you have a bunch of debt out there that's bad, you have a government that's going bankrupt, what do you think they're going to try to do? They're going to try to tax all this stuff. And if oil goes way up, they're going to try to tax the living heck out of it. So one way that you could indirectly play the oil boom is through precious metals, because you're out of the system protected. And I don't know if there's any way to really tax it. They can try to tax it on the sell, but at that point, it's just a desperate move. You can probably trade it outside of the system if it gets that desperate. And no one even knows. But I'm just looking at this from kind of a big picture view, trying to figure out what the heck they may try to do. And maybe we don't have an energy crisis. Maybe I'm just overblowing it. But it seems like it's spreading and getting worse. That's just kind of what my interpretation of the data is. Now, looking at oil price, we'll dive in here and I'll give you my analysis. Here's oil price, and I circled this area. This circle area is this move here. And I just put it so you can see it overlay. What I'm proposing is that this move, this pullback and consolidation period, which eventually broke out, is the same as this one here. And it may not be exactly the same, but it pretty much is the same. This little pullback there, right where the finger is, the pointer finger, is this pullback here. It's just amplified because we had a recession in it. And then we went sideways. This went sideways and it pulled down. That big pull down or sell off was here. So point number one is in the middle of this. Point number two is the tip of the downturn. We turn down, and the bottom of it is 3 right here. 3 is right here. We came up and went sideways a little bit. That's this entire portion there. Point number 4 is this whole section. This one's scrunched up a little bit. Now I had to, I squeezed this one out a little bit. That's 2010, 2020, 80 to 2000. Then we pulled all the way down to point number 5. And the bottom of point number 5 was the COVID sell-off. And then we pulled up and broke out of its pattern right here. We're just starting to break out. And if you notice in the last one, it broke out, pulled back and did a retest and then took off. That now, the pattern that always happens, the breakout, the retest, and then the takeoff. So in my opinion, oil from 2008 to 2021 has all the same ingredients of the pullback as 1980 to 2000 did. It's just in a little bit shorter time frame. So I think that oil is prime to take off. We'll probably do a back test, retest, and then we're going to really take off. So that's what I suspect. I don't know exactly how big the retest will be. That hasn't happened yet, but we still have to first break out. And I think we could probably go to 140 or 150 before we pull back a little bit, and then we take off again, if the conditions are there in the expansion phase of real estate, and they still exist and it's inflationary. Now, looking at gold, I also did this analysis in gold. Let me back out a little bit. I'll try to do it like this. Here's the gold price. We've got 1, 2, 3, 4, and then we broke up. This move is very similar to this move here. It's basically the same move. This one's more sideways. This one's got a little bit of a bottom here. So point 1, 2, 3, 4, I labeled it point 1, 2, 3, 4 of this circle portion up here. So this circle portion is this portion here. I included a little bit of the upward move before it. So 1, you kind of come around. It's this guy in here. It came down. There's your little hump there. Then we've got 3 that came up. We've got, it goes over and down, over and down. There's 4, and then we take off. Now, what about this point in here? So I zoomed in again. What I did is I took this entire area here and compared it. So this entire area here compared to just this portion here, we're zooming in. And remember, this pattern repeats over and over, the consolidation period. And we're in a consolidation period in gold right now. And I'm trying to see if we're done. And I think we're really close. So point 1, and remember, this is all scrunched up and it doesn't show the details as well as this. Point 1 to 2, so you come down, 2 is in here. It's the bottom here. We go across. 3 is this guy, this up and over hump. We got this coming across, which is this guy here, and 4 is the bottom, and then we go higher. We're right at 4. We are right at 4. So I think by looking at this movement, I think we're right there, and that we're about to go higher in gold. And again, guys, this isn't, it's just my financial opinion. I'm playing with things, trying to see if I can see patterns repeat. I could be wrong, but looking at what drives inflation and gold accounting for inflation and the eventual increase in interest rates, I think, is that's what I look for. It's another form of confidence, indication, more data to support a move that could potentially go higher, is to see the same consolidation pattern finish. So I think we're right there, and we've seen that consolidation pattern finish in platinum. And I think silver possesses something very similar. It's a lot more volatile and messy looking, but if they all exhibit it, I would suspect that it's the pattern is right, it's correct, and we're about to see a takeoff. Now, I want to talk about another thing here, and this is an if. I'm not saying it's going to happen, so don't. I'm just throwing ideas out. It doesn't mean that these ideas are going to come true, but what I do is I think in this type of way, I kind of a best case, worst case outcome. I'm looking at the tail ends of things. Now, money doesn't move unless money's lazy. It's like most human beings. They're kind of lazy. They don't want to do things unless they have to, especially when you get older, right? And money, I think, is very much the same way. And then you've got the innate thing of what's inside of people. The gains that people have are not felt as strong as the losses. So a lot of people just psychologically, they feel losses much more harshly, and they really want to avoid losses. So what's going to move money is higher interest rates, because what's going to happen is it's going to put pressure on stocks and bonds. And if we have a high inflationary environment and a rising interest rate environment, eventually interest rates are going to get to a we'll call it a pain threshold point, where bonds start to go down in price. Same with stocks. And it's going to trigger the psychological pain of seeing losses and people selling those, which will then beget more selling in stocks and bonds. It'll kind of start to feed on itself. Has that happened yet? I don't think so. And it has to become apparent to everyone. But when that does, when interest rates go high enough and hits a certain pain threshold point, and then people start feeling it, and they get scared, and they don't want to be in those investments anymore and they sell them, it's going to get that ball rolling of the rotation of money. And it's going to go into things that I think are going to be safer in an inflationary environment. And I think that gold, silver, those types of investments are going to see a huge inflow of money, massive inflow. Now, I'm going to set the market conditions here. When inflation's low and interest rates are declining, it guides money into, we'll call it stocks and bonds. So all of the inflation that was fictitiously created over 2009 till today has funneled into stocks and bonds. And we can see that in our ratio charts. We can see the Dow to gold ratio. It's at 20. It's incredibly high. We've got the stock to commodity ratio. It's at 100-year lows for commodities, and it's at all-time highs, that ratio, in terms of stocks in compared to commodities. So we can verify through ratios that the money has flowed into those assets, and when comparing those assets to other assets, they've never been more expensive. Now here's the cool thing. If all the money has flown into those, and we know that the interest rate is most likely going to cause the pain and the herd to change their mentality, to rotate that money out, then we just have to look at the leading indicators. In my opinion, the leading indicators are real estate, which is the expansionary phase. It's expanding. That usually aligns with a higher M2 money supply and then is offset by a year or two of inflation. Also, we've got oil taking off massively. And that's going to basically be the medium between the M2 money supply and how it exchanges into higher CPI prices. That's what's going to, I think, make everything apparent to everyone in the world. I mean, we're kind of on the forefront here. We're talking, we're ahead of everyone else. We know what to look at. We know what the leading indicators are on this channel. It's the expansion phase of real estate and oil prices and energy prices. Then it infiltrates its way through everything, and there'll be higher prices for everything. And if we have higher prices for everything, everyone looks at the CPI, which is a very huge leading or a lagging indicator and is heavily manipulated. But they're not going to be able to, in my opinion, they're not going to be able to manipulate this thing out. And if they are trying to hold gold and silver down, if they're trying to manipulate it, this is going to be a huge move when this thing breaks. Because when that money starts to rotate over, they're trying to prevent it from rotating. That's why they're holding interest rates down. That's the whole reason. They're trying to manipulate the rates down to keep that money over there, so people don't feel that pain. And then they're probably buying assets to hold things up so that money doesn't rotate. But if that money rotates, and it's all that money that's been created went into those sectors, all that money is going to come back out. And it's going to go into a much smaller area of commodities and energy. And I mean, it's going to blow everything up. So I think that a highly inflationary period is coming. I think the money's going to rotate when interest rates, they may even lose control of interest rates, comes back and rotates into commodities and precious metals. And if things get bad enough, and I don't know how bad things are going to get, I don't know. I'm not speculating here, but what happens when people start throwing all of their money at physical metals? That's when you're either in or you're out. I don't think there's a way to get in. You're going to have to be in it before. So what I've done, I've bought my physical metals. I'm preparing for a high energy price environment, and everything that I can look at, every single chart, every single pattern, the commodity to stock ratio, it's all turning right now. It's all bottoming and starting to turn up. And we're seeing these huge, big first moves, and they can come back and do a retest. We know that on the channel from all of these companies that we've been looking at. They break out and they retest. Lumber could be doing it. Nickel, all these, they're all going to probably eventually do it. Uranium, I think, is doing it right now. I think coal's doing it right now as well. Oil still needs to really break. So as far as I can tell, I can't see anything that would necessarily break it. Now, if China has a problem, which we're talking about for the real estate market, if that was a problem and the market perceived it as a huge problem, and people were thinking that it was going to crash the entire system, what you would see is interest rates on the 10-year yield drop. People would be running into bonds for safety, and they'd be running into the dollar. But we're not seeing that. So I don't think that is, at least the market doesn't perceive that as a problem. So that's kind of my take on it. And if it was really a problem, you'd see the gold to copper ratio revert and change, and it hasn't changed yet. Copper's still outperforming gold. And usually, if people think that, like banks and hedge funds and all these big money players, if they think that a crash is coming, you would see that copper to gold ratio dive down where people are going into gold instead of copper. Now, that doesn't mean it can't change. We're just not seeing it yet. And if some of these things that I described, you might see a huge run into gold, and maybe copper goes to the roof too. It maybe they go up in tandem, and that ratio doesn't change too much. And that's when things will get really funky, is if you see gold take off and oil take off, and they run up in parallel. And there might be high inflationary scenarios that are derived from this as well. Very high inflation. So we'll see what happens, guys. I don't have the answers for the future. I'm just kind of throwing out ideas, and you guys can kind of sift through it and take whatever you want. What I look for is if I can win here and it protects me here. That's a huge thing. That I look for that. And sometimes hitting the low risk button with physical metals, I hit that a lot too. So I'm doing a diversified approach. I've got physical metals, and I've got my commodity type stuff right now, and I don't have too much in anything else because these input costs are going to crush, I think, a lot of the other sectors where they use commodities as inputs. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.